Okay, so let's continue with part 4 of IAS 2. In this session, we are going to look at the subsequent measurements of inventory. And so we did the initial measurement already, right? So in this video, we are going to look at the subsequent measurement of inventory. So when we say subsequent measurement, what do we mean? What do we mean by subsequent measurement? It refers to the process of evaluating the value, right, of an asset or let's say liability after the initial recognition or at the reporting date. So what value do you give to the inventory, to the asset at the reporting date or after the initial recognition, right? So we said for the initial recognition or the initial measurement, we said all inventories are initially measured at what? Cost, right? The subsequent measurement says that inventory should be recorded at the lower of cost and net realizable value. At the lower of cost and net realizable value, right? So don't forget that initially the inventory should be measured at cost, and then subsequently it should be at the lower of cost and net realizable value. So very important. So far I believe you're following from the first video to this one, and I'm sure you are getting things right. Okay, so let's proceed. Let's continue with the subsequent measurement. Let's proceed with the subsequent measurement. So it says subsequently, inventory should be measured at the lower of cost and the net realizable value. We know what goes into the computation of cost, right? We know what goes into the computation of cost. Very good. Now, what about the net realizable value? What about the net realizable value, right? So, as you may know, when we talk of net realizable value, as the name implies, net realizable. So how much will you obtain net realizable value here, right? So how much will you get from selling the asset, right? After you have lessed your cost to sell and your cost to complete, right? So this is net realizable value here is the estimated proceed from selling the inventory less estimated cost to complete and estimated cost to sell, right? So it is telling us that, okay, to get our net realizable value, we bring our selling price or proceed from selling, then we less our cost to sell, and then we less our cost to complete. That's the completion cost, right? So that's what it is saying, that to get the net realizable value, it is our estimated proceed from selling the inventory, that's the selling price, then we less the cost, any cost we incur to sell, okay, like transportation, carriage outwards, and then the rest, right? So any cost that we incur to sell the inventory, then we also less the cost to complete. Now, this is the general principle or the general subsequent measurement. It says your net realizable value, NRV, is equal to your selling price or your sales proceed less cost to sell, less cost to complete. Very good. Now, there's more to it, okay? And it says, this thing is also very important. It says on a line by line basis. What do we mean by line basis, right? Let's say we have two inventories. We have A, okay, and B. Now, the cost of A and then the net realizable value. Let's say A, the cost is 5 million, net realizable value 6 million. B, cost 7 million, net realizable value 3 million, right? So we sum this one 5 and then 7 will give us 12. Then 6 and 3 plus 3 will give us 9. right? Now, if you are valuing this inventory, the standard say we should use the lower of cost and net realizable value, right? So total cost of the two is 12, total net realizable is 9. So which one are we going to pick? Are we going to pick the 9? The standard says we should value them line by line. So it means come and value A separately and come and also what value B separately. So come to A, pick the lower, which is what 5. Are you following? Come to inventory B, what's the lower of the cost and then the NRV? 3. Sum the two and you get what? 8. So 8 is what we are going to what? Use, not the 9, which is the lower of the cost and then the NRV. This is the total. We're not going to use the total, but we're going to value them on the line by line what basis. That's what it means, right? So you don't have to use the total 12 and compare to the total 9. You have to value them separately. So A, the lower is 5, which is the cost. B, the lower is 3, which is the NRV, right? So you add it and you get your what? Your 8. That's the meaning of this line by line what basis. Now let's continue. Let's look at how to value the three main types of inventories, right? So let's pick the finished goods. So with finished goods, we said the formula is net realizable value. I mean, to get the NRV, that's the most important thing, the net realizable value. It says we pick selling price minus cost to sell minus cost what complete. But if you pick finished goods, you should know that finished goods are already completed. So there is nothing like cost to complete. I want you to really understand this. There is nothing like what? Cost to complete, because finished goods are already what? Completed. Are you following? So in that case, in the NRV formula here, the value for the cost to complete will be 0 because there's no cost to what? Complete. The event is already what? Completed, right? So if you are valuing finished goods, okay, normally the NRV here for finished goods is usually your selling price, that's estimated proceeds from selling, minus cost to sell. And sometimes the inventory might be damaged. Some are damaged and might need some repair. If that's the case, then minus cost to what? Repair, or repair cost. Okay, minus your repair cost. That's repair cost, so it's RC. Okay, so we said if the inventory is damaged and it's normally finished goods, then if you are valuing it, we pick the selling price, that's the estimated price from selling, then we less cost to what? Sell, and then cost to repair if it is damaged. We factor in the cost to what? Repair, right? So if you are valuing inventory and the inventory is finished good, normally we cancel this part, cost to complete, the CC is out for finished goods. There's no cost to what? Complete. It's already completed. Okay, so the cost to complete applies to what? Work in progress. But I'm saying again that finished goods sometimes they are damaged and they might need major repair or some repairs before they can be sold. If that's the case, then we factor in the cost to repair. Okay, so the net realizable value will be like your selling price minus cost to sell minus cost to what? Repair. That's the finished goods, right? Then we come to work in progress. So for work in progress, it's NRV. Okay, so work in progress, it's NRV, the net realizable value is the normal thing that we know. Selling price minus cost to what? Sell minus cost to what? Complete, right? So don't forget, there's slightly different between the two. If you're valuing finished goods and then what? Work in progress. Work in progress will bring in the cost to complete because they are not completed. So we bring in the cost to complete. And then for finished goods, normally they are completed. So there's usually no cost to complete. But rather, if they are damaged, then we have to repair. Okay, sometimes we can repair them before we can sell. So in that case, we bring in the cost to repair. So selling price minus cost to sell minus cost to repair. So that's for work in progress and finished goods. For raw materials, there's a note here. It says raw materials are not written down below cost. If the finished goods they will form a part of will be sold at what? A profit. You should understand this sentence. So it says, let's say, even though you realize that, okay, for the raw materials, okay, probably their prices are declining, right? So if probably you should sell, or if you should compare the cost and then the NRV, you realize that the cost might be bigger than the NRV. The standard is saying that, okay, even if that's the case, but the finished goods that these raw materials are part of will be sold at a profit. Then it says you should never write down the value below the what? The cost. So it says the raw material should not be written down below cost. If the finished goods will be sold, the finished goods that they form part of will be sold at a profit, right? So normally raw materials, look at the finished goods that these raw materials form part of. Would these finished goods be sold at a profit? If they'll be sold at a profit, then you should never write down the raw materials below the cost. Okay. In other words, it should not be written down. In other words, you don't have to record the value for the raw material below the cost, right? Even if the selling price of the raw material, like it is low and it's indicated right down. So far as the finished goods that these raw materials form part of will be sold at a profit, then we don't have to record or we have to record the raw material below the cost. Very, very important, right? But it is, however, a decline in raw material prices will suggest that their NRV has what fallen below has fallen below what the purchase cost. In such cases, the replacement cost of the raw materials provide evidence of what their NRV of their NRV, right? So what do we mean? It is the standard is saying that okay, if um there's a decline in raw material prices, right? And then we realize that this reduction, okay, will suggest that the NRV has what fallen. The net realizable value has what the net realizable value has what fallen, right? Then it's we would need to write down the raw materials. We would have to compute the value to be recorded in the books. But it is saying in such case, we should use the replacement cost here. Very important, the replacement cost of the raw material as their net realizable value. Okay, so it's like there's if you should really understand the standard, like this is what the standard is trying to tell us. The standard is trying to tell us that okay, for raw materials, usually they are not meant for resale. So why should you worry yourself with their net realizable value, right? The standard is been saying that if there's a decline in raw material prices, it says we should use the replacement cost. Are you getting it? To measure their what? Their NRV, right? So that's the idea. Raw materials are not usually meant for resale. So where there's normally a reduction or a decline in raw material prices, then we'd have to get their NRV, okay, and then compare with the cost. But since we should use the replacement cost as the NRV. Now, with the replacement cost, what is the replacement cost? So replacement cost, is not the same as the actual cost, okay, or the historical cost. Replacement cost is the cost to replace an asset or inventory at the current market price, right? Or the price that would be paid to acquire the same or similar asset today. I follow me. Huh. So that's it. Whilst like the historical cost or the actual cost is the cost that was actually incurred, the price you paid for the asset or for the inventory at the time of purchase. Okay, so the price you paid for the asset at the time of the purchase is the actual cost. But the replacement cost is like, okay, how much will you pay to replace that same asset today? Are you getting it? How much will be paid to acquire the same or similar asset today? Okay, so purchase cost is the amount paid initially to acquire the asset, while the replacement cost is the estimated cost to replace the asset with a similar one, right? Considering things like maybe probably market prices and the potential depreciation. Okay, so the standard is saying if we realize that there's a decline there's a decline in raw material prices, then we have to use the NRV to value it. And don't forget that if um the finished goods that these raw materials form part of will be sold at profit, then you should never value the inventory below their cost. So that's the same thing here. Okay, I think the same explanation here. The next slide, the same explanation, right? Okay, if the finished goods will be sold at goes above, then there's a decline. Then we have to measure them at replacement cost of raw material. Like, yeah, so it's the same thing I've explained up there, right? Okay, very good. So don't forget that. Okay, don't forget. that. Now let's look at um so there's a question here. Let's try this question. Let's try this question. Let's see if you really understand raw materials. So let's try this question. It says materials costing here. So let's start drawing. Materials costing 12,000 cedis, bought for processing and assembly for a sorry, this is material costing 12,000, bought for processing and assembly for a profitable special work order. This is for a profitable special work order. Since buying these items, the cost price has fallen to what? 10,000 cedis. And the question is, what value do we record in the books as a value for what? Inventory. What value do we record in the books as the value for what? Inventory. So you can pause the video and then see if you can answer the question. So we use the 12,000 or the 10,000, right? You can pause the video, think more, and then let's get back. Now, we are to use the 12,000. Sorry, sorry. Now, we are to use, so let me ask the question again. Which one do we use? Are you following? Which one do we use? Which one do we use? Do we use the 12,000 or the 12,000? I'm sorry, the 10,000. Now, we are to use the 12,000. Don't confuse yourself with the lower of cost and the net realizable value. So, I might say, okay, the cost is 12,000, NRV is what, 10,000. So, let me pick the 10,000. No, the answer is 12,000. Do you know why? Because of two main things. One, this is why the answer is what? 12,000 and not 10,000. Now, do you, from the next slide, the slide we just left, it says, this is very important. It says here, that raw material should not be written down below cost if the finished good they form part of will be sold at a profit. That's the same thing here. That's one reason. That's the same thing here. It says the material cost 12,000, right? But it says for a profitable special order. Profitable special order. It's here. Profitable special order. So the order is profitable. So even though the value has fallen, right, we will still use the 12,000. And it says the inventory and the material should not be written down below cost. Listen, oh, you shouldn't write it down below cost. If the finished good that they form part of will be sold at a profit, we are told that this 12,000 here, and this for processing and assembling, and this processing and assembly will be for a profitable order. So even though the value has fallen, we are still not going to write down the inventory below 12,000. It should be what? The 12,000. Another reason is that the rule is that we have to value inventories below, we have to value inventories using the lower of what? Cost and net realizable value, not the lower of cost and replacement what? Cost. Listen, we are value inventory using the lower of cost and net realizable value, not the lower of cost and replacement what? Cost, right? So this 12,000 is the cost, this 10,000 is the replacement cost, not the selling price. It says since buying the items, the cost price has fallen to 10,000. So if you should buy a new inventory right now, if you should like maybe try to get a similar material right now, it will cost you 10,000. Don't forget, not the NRV. Are you following? So in a nutshell, what we are saying is that okay, we are valuing inventories and the raw material. So the key thing that you should know, okay, is that um the key thing that you should know is that here it says that the order is profitable. Okay, even though the price has fallen, the order is the special order is what? Profitable. The special order is what? Profitable, right? So since it's profitable, you have to write the inventory below the 12,000, below the cost. It's in the standard. And then also we said that this 10,000 here, this 10,000 here, okay, it's not the selling price of the inventory. Okay, it's not the selling price of the inventory. So the rule is that we have to use the lower of cost and net realizable value, right? So this 10,000 here is not the net realizable value. So we have to use the 12,000. And then the reason is very simple. We said the order is profitable. So we don't have to write down the inventory below 12,000. Let's look at accounting for write down. What do we mean by write down? There's inventory write down when the cost is greater than the NRV, the net realizable value. So where the cost is greater than the net realizable value, there's a write down, right? Now, what do we mean? Let's say we measure inventories at the lower of cost and the net realizable value. Let's say the cost is 50, net realizable value is what? 40, right? So in our books, we use the lower, which is the 40. There's a write down, the value of the inventory has gone down, right? So there's inventory write down when the cost of the inventory is bigger than the NRV. So in a way, if you should sell, you make like a loss. That's what it means. So there's an inventory write down. But if the net realizable value is bigger than the cost, there's no write down. But if the cost is bigger than the NRV, there's what? An inventory write down. So very simple. Where cost is bigger than net realizable value, there's an inventory write down. Before we look at the slide, what are some of the causes of inventory write down? What will make the cost price bigger than the net realizable value? It makes sense. One is decline in what? Market price or market what? Value, right? So where the market prices of the inventory declines, okay, it will make the selling price less. And when the selling price is less, we will have a smaller net realizable value, right? So a decline in what? Market value. Damage. Second one is damage. The inventory might be damaged or spoiled. Therefore, you can't sell it at a higher price. So the cost is likely to be greater than the NRV. And also we have something called the obsolescence. Obsolescence, right? So inventories become outdated or obsolete due to technological advancements or changes in what market demand. So new technology can render some inventories what? Worth less, right? Very good. Then we also have overstocking. Okay, overstocking, excess inventory is held, and the cost of holding it exceeds its value. Yes, so there's some of the costs. So we have them. That's what we have here. Due to damage, obsolete, falling prices. So these are the costs of what? Um, event write down. Okay, these are some of the causes of event write down. What will make the cost price bigger than the selling price? So now, how do you treat event write down? Right, it's when sold, expense as cost of sales in the period when the revenues were recognized. So when there's a write down, what are the entries? We will debit, okay, and then we'll credit something. Because the inventory figure has gone down, we'll credit inventory, okay. So you credit the inventory figure and then you debit what? Your cost of sales. Don't forget. So these are the entries. Debit cost of sales and credit inventory, right? So here, if you look at these two, okay, or when you compare these two stuff here, the 50 and the 40, you realize that there's a write down of 10, okay? There's a write down of 10, and that 10 is what we are going to debit cost of sales with the 10 and credit inventory with what? The 10. Now, normally, if you are computing your cost of sales, this 10, the difference, the 10, the write down, you don't usually do anything to it because, but we use the 40 as the closing inventory, the lower, right? The lower of the cost and then the NRV. If NRV is 40, we use the 40 as the value of the inventory. Now, immediately is 40 as the value of the inventory. This 10 is automatically added to cost of sales because how do we get cost of sales? Opening stock, we add purchase, and we less closing stock. So if you less 40, if you less a smaller figure, if you less 40, a smaller figure, right? You are adding the 10 to cost of sales. So usually we don't do anything. If there's a write down, usually just get your closing inventory 40 and go and less from your cost of sales. And automatically tell what added. Are you following? So don't forget that if there's a write down, we will debit cost of sales with the 10 and we'll credit inventory with the 10 as the write down. But as I said, we don't go and then do it. So first you less your closing stock from your cost of sales, the 10 will automatically be added. So this is the entry where there's a write down, debit cost of sales, credit inventory, and then it says we'll come to reversals. Any write down or reversal should be recorded in the period which they occur. And then if used in the construction of property, plant, etc., the write down should be what? Capitalized and expended over the useful life of the asset. So they're saying, okay, if the inventory is used in construction, used in the construction of property, plant and equipment, then add the write down. It should be added to what? And the cost of the PPE. Then it will be depreciated, right? So it should be added to cost of the PPE. You see, if it's normal inventory, we add it to cost of sales. That's mean debiting cost of sales, right? Okay. Now let's look at the reversal of what? Inventory write down. Reversal of what? Inventory write down. Okay. Now let's say because of the factors that I mentioned, decline in market prices, obsolescence, and stuff, factors that cause inventory write down, they forget, and so you have what? Really, or you've actually accounted for the what? The reversal. I'm sorry, you've actually accounted for the write down by debiting your cost of sales and crediting inventory. Let's say the factors that cause the reversal are no more. Those factors are gone, right? It's not saying, okay, in that case, we have to come and do what? Reverse. So it says NRV is assessed in each successive what? Period. If changes in economic circumstances warrant, earlier write-downs are reversed to make the new carrying amount equal to the lower of what? Very important, cost and the revised NRV. Now, what are they telling us? They are saying that, okay, where there's reversal, like the fact that I hold the write down, they are gone. They have to reverse that stuff. And then you see the reversal is capped at the original cost, right? And it says reversals are recorded or recognized in P&L in the period in which the reversal what occurs. So looking at the previous example here, if you come here, cost was 40, NRV was what? So you see we had cost to be what? 50. So cost was whatever 50, and then the NRV was what? 40, right? So we recorded a write down of what? 10, right? Now let's start saying, okay, let's say the following year, right? Um, we have reassessed the NRV, the net realizable value, and it has gone up. So cost is still 50, right? 50, but the revised NRV now is no more 40, but what? 60. So the NRV has gone up 60, right? The science say we should pick the two, the lower of the cost and the revised NRV 60. And that's what we are going to record in our book. So now we'll be recording the inventory as well 50, because that's the lower of the cost 50 and the NRV 60, right? So we compare the lower of the cost and then the revised NRV. So the cost was what? 50, the revised NRV was 60. So we compare the lower. So we are going to record 50 now as the cost of the inventory in our books, not the previous what? 40. Now, you see, there will be a reversal of what? 10. Are you following? So we have to reverse because previously we recorded 10 as write down, this 10. The difference between the 50 and the 40. We recorded 10 previously as inventory write down. So now that the condition, what caused the write down is gone, we have to go and reverse it because now our carrying value has increased. It's now 50 instead of what? The previous 40. So this 10, we have to go and reverse the 10, this 10, previous 10 that we have recorded in our books, in it, that we've added to what cost of sales. We have to go and reverse it, right? So it's similar to the first one. We just have to go and reverse. So if you are reversing, how do you reverse? When we're recording the write down, we debited cost of sales, right? And we credited what? We debited cost of sales and then we credited um, inventory. So now it will be the other way. We are now rather going to debit inventory, and then we are now going to credit cost of what? Sales. So credit cost of sales. Okay. Credit cost of sales, which how much? The 10. Okay. So we have to reverse the write down, the 10 that we have what? Recorded as a write down. We have to go and what? Reverse it. So we debit inventory 10 and we credit cost of sales or P&L. Don't forget we credit cost of sales or P&L. Meaning that we have to go and deduct. You see, if you are crediting cost of sales and expense, so if you are crediting cost of sales, means you are deducting and reducing the expense. Be very careful. So you have to go and reduce cost of sales by crediting cost of what? Sales, right? So it is how we account for reversal of net realizable value, right? So let's pause here. Let's pause here and solve more questions in part 5 of IAS 2, right? So in part 5, there are so many questions. We are going to solve more questions on this. Okay, we have complex or complicated questions. We are going to solve them, and then we are going to continue with our cost techniques and our inventory valuations, right? So this is part 4 of IAS 2, right? So if you like the video, please subscribe, okay, and turn on the notifications so that anytime I release a video, you'll be notified, right? Comments are what welcome. Suggestions if you want me to do something better or probably solve more questions, my content, everything, you can just let me know what you think. So I'll see you in part 5 of IAS 2.